Russ Appel, founding principal of the Praedium Group, and I was hoping to spend a few minutes talking about risk. I think as we get later cycle and as the economic cycle extends, more and more people are thinking about risk and what's important in thinking about risk in their real estate portfolios. Some of the traditional thinking about risk and risk mitigation, people's immediate thoughts are diversify. And I think there's a lot of benefit in thinking about diversification, but there's a lot of ways to diversify. I think that the immediate thought is diversify by product type or diversify by strategy, or there are other thoughts about risk. And what I really wanted to do was just provide some additional thoughts on diversification, on risk mitigation, and how people may want to think about positioning their portfolio, particularly given the light that people have kind of actuarial requirements and don't want to just, just diversify. Some of the questions today involve how do I manage risk and achieve my actuarial hurdles? And I think this is a real challenge for institutional investors today. One of people's thoughts on risk mitigation, besides diversification, is focus on primary markets. I think historically one of the things people thought of was there was less risk in primary markets. I will tell you that when we look at demographics and migration patterns, it's unclear to us that primary market concentration will really be a risk mitigator. In fact, when we look at migration patterns, and some of these have accelerated since the 17 Tax Act, we see more migration into some of the secondary markets, markets where housing is more affordable, where it's easier to do business, and where taxes are lower, cost of living is lower. We see that in places like Florida, places like Arizona, places like Texas. And I think when people think about diversification and they think about risk mitigation, I think secondary markets may be a good place to start looking to diversify. Another thought on risk mitigation historically has been physical quality. People used to think that the highest quality assets traditionally had the lowest risk, physical quality. I think some people are starting to think differently. Some people are starting to think that quality and durability of cash flow is really what's less risky. And I think that, again, is a way to think about diversification. When people are thinking about durability and quality of cash flow, some of us think of three elements. We think of demand, we think of supply, and we think about CapEx. Because cash flow is different than income, and how can we be protective and diversify into more protective assets? What do we say when we think of demand? Well, one of the things that we're seeing across property types really is technology and the changes in technology, and they're impacting demand. Retail, historically over long periods of time, had been among, if not the least volatile, if you look at the NCREIF statistics. And yet today, retail is one of those product types that we're seeing some structural changes basically due to e-commerce. So one of the things we're looking at is demand and how demand is being impacted by demographics, migration, technology changes. An additional thing, the way we think about cash flow, is supply. Where is supply the greatest or the least, and how that could impact future cash flow? Again, one of the things historically people thought of is the highest physical quality, the highest price points. Again, across property types, people thought of as core or of lower risk. But actually, new supply often comes in at the highest price points. And so what we're seeing is, again, owning properties that could deliver at lower price points maybe is more protective, and again, maybe a place to diversify into. And then the last element that I wanted to address with respect to cash flow and risk mitigation relating to cash flow and durability of cash flow really is CapEx. And different property types have different requirements relative to CapEx. Again, office and today retail we see as areas of higher required CapEx. So if what we want to do is produce durable cash flow, cash distributions to people's portfolios, again, as we think of diversification, we're thinking about demand and its impact from demographics, migration patterns, and changes in technology, supply and different price points, and also CapEx requirements. Then the last thing I'd like to address as well with respect to risk mitigation is financial risk and leverage. And I think that historically, again, people thought of core as unleveraged, and clearly that has less financial risk. But because people do have actuarial hurdles, I think people today, given the very low cost of debt, are thinking more about conservative and responsible levels of leverage, which also helps with respect to the actuarial hurdles. But levels of leverage can enhance return. It does add risk. So when you think about de-risking, we do think about levels of leverage, and not just the required debt service, because with rates so low, clearly debt service requirements are lower, but also sooner or later you have to pay back that leverage. So the three elements of risk that I really wanted to address really was the markets, primary markets, and maybe diversification into secondary markets. Quality, really physical quality versus quality and durability of cash flows, and then financial risk or leverage, which again, leverage does add risk. However, it is very helpful in terms of achieving actuarial hurdle rates and rates of return. With rates this low, I think there is more thought of utilization of prudent and conservative levels of leverage still in a managed risk portfolio. So again, in a discussion of risk, we think that as we're late cycle, there is a prudence to be focused on risk. But risk and managing risk really should be a dynamic process. There are, ways to manage risk and de-risk as we're getting later in a more extended economic cycle. But at the same time, as people think of that dynamically, there are more than one way to diversify, and there are ways to utilize leverage to achieve certain returns, but while still keeping risk at a more moderate level. It's interesting as we think of risk, we also think within our own organization of many of our young people. So we have a bunch of young people who are exceptionally talented and who have been with us for the last 5 to 10 years. But yet, over the last 5 to 10 years, we've seen, sort of almost all upside. And, again, one of the things that we need to teach our people as we have them become more independent in terms of their contributions to organizations, we need them to think that downside scenarios are not just 1% less market growth and maybe 25 basis points higher exit cap rates as a downside scenario. Many of these people, because they've been around for the last 5 to 10 years, have really only seen the upside. So part of the challenge I think many managers face today is how do we educate our young people on risk and what happens in more downside scenarios? How do we think about that going, on a forward look in terms of the investments movement make and how different investments may behave differently in a disrupted economic environment? And at the same time, how do they then help us better manage the assets in those periods of time? And I think that it is necessary for fiduciaries to really enforce that on their team and to the best they can, train their people to be thinking forward to that. I think that's a challenge to all of us in the industry as we, again, are thinking about the fact that we are later in the economic cycle, that the cycle has gotten extended, and that, again, sometimes the best way to manage risk is to be, really thinking about it and educating people's team on the best they can, because obviously until you actually experience and sort of work your way through the individual problems yourself, it is hard, but it is, I think, one of the challenges for the industry. I think whether you're at an investor, at an investment manager, at the service providers, it's really a challenge for all of us. And I know it's something we're focused on, and I know as I speak to, some other of, other people who manage organizations in the industry, I know it is a challenge that hopefully we're all focused on.